Welcome to UK Pension Guide. In a major financial update for 2025, HMRC has introduced new rules that could significantly impact pensioners and individuals over 65. Many older citizens who thought their pensions and savings were secure may now face unexpected tax adjustments, withheld payments, and potential backdated tax claims. This isn't a minor technical change hidden in fine print. It represents a nationwide shift in how pensions, savings, and benefits are reported and taxed. Financial experts warn that those who do not take proactive steps could see losses reaching £10,000 or more due to frozen accounts, automatic tax adjustments, or missed entitlements. If you're over 65, receive any form of pension income, or hold more than £3,000 in savings, this guide is essential. Let's explore what's changing, who is most affected, and how you can safeguard your money before the new rules take effect. The 2025 HMRC rule explained the changes coming in 2025 are not just a single regulation, but a set of administrative updates affecting how HMRC monitors and reconciles pension income and savings interest. For years, HMRC has relied on older systems that sometimes failed to accurately cross-check pension payments from the DWP, bank interest, and tax-free allowances. Starting in November 2025, a new real-time digital system will come online. From that point forward, every incoming payment from state pensions, private pensions, savings interest, and similar sources will automatically sync with HMRC's network. While the update promises better accuracy, it also means any past discrepancies or unreported income could trigger retrospective tax claims. HMRC's automated system will flag unusual income patterns, and pensioners receiving multiple small payments are at highest risk. Even minor rounding errors could trigger investigations or delays, and many may not receive notifications until after adjustments are made. This marks the first time Her Majesty's Revenue and Customs and the Department for Work and Pensions will operate under a fully unified income tracking framework, which could have wide-ranging effects. How £10,000 in losses could occur. Many pensioners may wonder how losses could reach such a high amount. The key lies in retrospective tax recalculations and adjustments to allowances. Under the new rules, HMRC will review past tax records and verify whether all income was correctly reported over the last 4 years. Even small errors or omissions in state pension, private pension, or savings interest reporting can lead to backdated corrections. For individuals whose combined income slightly exceeds the personal allowance, these corrections could quickly amount to thousands of pounds. HMRC may also freeze pending tax refunds or adjust ongoing payments automatically to recover unpaid taxes. Missed interest on savings or previously unreported dividends can generate unexpected tax bills. Adjustments can occur mid-year without advanced notice, and pensioners could find future payments reduced to account for past underpayments. Financial advisors stress that verifying your tax records now is crucial, as waiting until deductions occur could make recouping funds more difficult. Who is most vulnerable? Not all pensioners will be affected equally. Those most at risk include individuals over 65 with multiple small pensions or joint accounts, retirees receiving interest or dividends that were not previously reported annually, those transitioning from working-age pension credits to a full state pension, pensioners relying on automatic tax codes rather than self-reporting. For instance, someone with a state pension, a small private pension, a building society account, and some dividend income may unknowingly exceed their personal allowance once HMRC system consolidates all sources. This could trigger sudden tax bills or deductions, causing confusion and financial strain. Expanded HMRC DWP data sharing. A central driver of these changes is the HMRC DWP Data Integration Project, set to launch in late 2025. For the first time, DWP payments, including universal credit, pension credit, attendance allowance, and winter fuel payment, will feed directly into HMRC's tax system. The goal is to reduce fraud and ensure accurate entitlements, but critics argue it functions like an automated audit. Pensioners who previously received overlapping benefits or had small reporting errors may face repayment demands or delayed payments, as the system reconciles data tax codes will now be automatically updated based on DWP data. Joint accounts and couples benefits will be matched, and any discrepancies could take months to resolve banks and savings reporting changes. From November 2025, banks will be required to report interest earned on savings more frequently, quarterly, instead of annually. This change primarily affects individuals with accounts exceeding £3,000 or those earning interest previously below reporting thresholds. While the intention is transparency, it could cause confusion for pensioners who do not track monthly interest over £500, may trigger HMRC review, and linked savings accounts or older accounts may also be scrutinized. Pensioners are advised to gather updated statements and verify records to prevent errors, as incorrect reporting from banks can take months to correct. Financial planners recommend reviewing all accounts, including old savings books, well in advance. Steps to protect yourself. The most effective way to avoid issues is to review and verify your tax information before the system goes live. HMRC recommends all over 65s log into their personal tax account at least once before November 2025 to PUI by Fines IT2. Check your current tax code, review all declared sources of income. Look for open cases or pending corrections. If anything appears incorrect, report it immediately. Waiting until after deductions could make resolving issues much more difficult. Practical steps include requesting a complete tax history review from HM Revenue and Customs, verifying bank and pension statements from 2021 to 2025, confirming that all tax-free allowances are applied, contacting pension providers to ensure income is reported correctly. Proactive verification now can prevent thousands of pounds in potential losses. Later, how HMRC calculates pension income. Under the new system, HMRC will sum all taxable income sources, including state pensions, private pensions and annuities, savings and bond interest, dividend income, property or rental earnings. The total is reduced by your personal allowance, currently £12,570. Anything above this threshold becomes taxable. However, for many over 65, the personal savings allowance £1,000 for basic rate taxpayers may be reduced if total income exceeds certain limits, which could inadvertently trigger tax on previously untaxed savings. HMRC's automated unreported income review. One controversial element is HMRC's automated system designed to detect unreported income. Even legitimate income may trigger flags, including backdated pension payments, transfers between accounts, cashing old investment bonds. These triggers could result in frozen refunds or recalculated tax liabilities. While HMRC emphasizes fairness, this could create stress and confusion, particularly for pensioners less comfortable with digital systems. What to do if you're affected? If HMRC identifies unpaid taxes, they may adjust your tax code for upcoming payments, deduct amounts directly from your pension offset pending refunds, issue formal demand letters. It is essential to maintain records of income statements and correspondence. Acting quickly can prevent escalation. HMRC usually prefers gradual recovery, but ignoring notices could lead to sudden deductions from pensions or linked accounts. Looking ahead, 2026 and beyond, analysts predict these changes are only the beginning of HMRC's move to fully automate pensioner taxation. By April 2026, all pensioners may have a single digital income account where payments, deductions, and tax updates occur instantly. While automation promises efficiency, it also removes human oversight, increasing the risk of false flags and automatic deductions. Many pensioners may experience delays and uncertainty as errors are resolved. Final thoughts. Although this 2025 HMRC update may seem technical, its effects are significant. Thousands of pensioners could find themselves facing unexpected deductions without fully understanding why. The combination of automated data integration, bank reporting, and retrospective tax reviews makes this an issue that cannot be ignored. If you or someone you care for is over 65, now is the time to review finances, check HMRC accounts, and seek guidance. Taking early action can safeguard your hard-earned savings. Subscribe to UK Pension Guide for clear, verified updates on HMRC, DWP, and pensions, and stay informed about changes that affect your income. The next update.